To bring in Phil Orlando, Federated Investors Chief Equity Strategist on this. Good to see you, Phil. Thank you so much for joining us.
Thanks for having me back.
Expectations for the jobs number.
We're right on consensus at 163. Consensus is 160. The bigger issue, I think, is going to be this Verizon strike. I think there are about 35,000 workers associated with that. So the question is, was there an offset with temp hirings to replace them, or were there management people that replaced them, and therefore the number's clean at 160 or so? So there's going to be a little confusion. It's going to be a sloppy number,
right.
So we'll have to sort of get our hands around it.
And this would be a second straight month of sloppiness, right?
April was poor.
Yeah.
So the Fed's got some hard thinking to do for that June FOMC meeting with 2 bad months sort of in the bank.
Yeah, Joanie, how do you see it?
Yeah, you know, I think that today is a big jobs report because we had been averaging over 200,000 jobs every single month. So, you know, to see last month and then the expectations being 160, not very strong. So I think we need to look at revisions to see, did they revise last month up? I'm a little more optimistic. Hopefully we will see a larger number today. But it is interesting to see that, you know, again, most of this job creation is really in the professional service sector.
Right.
The jobs are in healthcare. They're in information technology. Engineering is still very strong. But we're not going to see manufacturing, and probably not a big number in construction.
They lose jobs, manufacturing.
Yeah.
But, you know, you talk about this sloppiness. We call it sloppiness in the job numbers. But it's a little more serious than that, isn't it? Because the markets have really been standing on these job numbers now for months. It's been the one bright spot in the economy. So, I mean, is it a little bit more than sloppy? Is it really bad news looking ahead for the rest of the year?
And that's a great point. We can't lose sight of the fact that first quarter GDP was only 0.8%. Yeah. That's 4 quarters in a row that's been poor. First quarter revenues and earnings, we've been in an earnings recession for a year. So maybe the jobs are reflecting the fact that the economy is just sort of limping along. We're not growing that strongly.
Right.
But, you know, the wage piece is going to be interesting as well. You know, wages were up last month, and they're expected to be up again. We saw consumer spending and retail sales were stronger last month. That's a sign that, you know, people are feeling it more in the wages.
Yeah, you mentioned that in the most recent report. Consumer spending was doing better than you thought.
Yeah, the consumer spending number was really strong, and a lot of the housing numbers have been decent.
The housing has been good, too.
Construction is still so-so because there's not actually enough inventory out there, but housing, in terms of the sales numbers and the price gains in homes, have been solid as well.
So, following up on the consumer spending number, the April number was terrific, no question about that. But the March number was horrific.
Right.
Now, one of the things that we do is we look at Maypril, the combination of March and April together, because of the calendar swing with Passover and Easter every year. The Maypril number, March and April combined, was not particularly good.
Okay.
It was only marginally better than last year. So I think you've got to look through the strength that we saw in April, admittedly, because March was so weak.
So what are you expecting rest of the year in terms of the economy? Do we continue to just bump along the bottom, as you put it?
So 0.8% in the first quarter. We do expect to see a jump up to about 2.1% in the second quarter and sort of stay at that level the rest of the year. But there are a lot of folks that are saying, you know what, it's going to be like the last couple of years where you had a bad first quarter and then the second quarter jumped up to like 4 or 5%. We don't see that because there was a weather impact that benefited the second quarter the last 2 years. So 2% is sort of the trend that we can reasonably expect the rest of the year. That's not great.
And because it's not great, a 2% backdrop is not great for stocks in your view.
Well, not great for stocks, not great for earnings. With the market having rallied, with the market having rallied here 16, 17% in the last couple of months, we're positioned nervously. We're defensive. We think there's going to be a rollover this summer. You've got the Brexit vote. You've got concerns about inflation and the labor market, you know, economic growth, corporate earnings. All of that suggests to us that if we get some sort of some ugliness surrounding the political cycle, and that's a fairly high bet at this point,
I think so.
We could see a pullback over the summer.
All right. Well, we'll be watching that. That's important.
Thank you,
Phil,
Mary.
great analysis as always.
Thank you. Thank you.
Phil Orlando, Federated.